The same piece of paper that protects a 26-year-old selling handmade candles on Etsy is the same piece of paper that shows up in a federal indictment, 3 paragraphs before the phrase wire fraud. Same document, same state filing system, same $50 fee. The difference is not the structure. The difference is everything that happened inside it afterward. That is the first thing you need to understand about shell companies, and it is the thing most explainers skip because it is not as clean as a definition. So here is the definition anyway. A shell company is a legal entity that holds assets, contracts, or liabilities, but does not conduct active business operations itself. That is the neutral version. The loaded version is what you hear on the news. A hollow vessel used to obscure money, dodge taxes, and insulate someone from accountability. Both versions are technically accurate. Neither version tells you whether the thing is legal. The legality comes from the behavior, the reporting, and the intent. Those 3 things are doing almost all of the work, and most people building their first entity have never been told that clearly. An operating business is different. It has employees or contractors. It has customers. It invoices work. It files payroll taxes or 1099s. It has a purpose that a stranger could describe in 1 sentence. A holding company sits above that. It owns things, interests in other LLCs, real estate, intellectual property, equipment. It does not sell anything directly. It receives income from what it owns. A single member LLC formed to hold 1 rental property is functionally a shell. A single member LLC that you run your freelance copywriting business through is not. The same 4 letters on a state certificate mean completely different things depending on what you put inside them. Level 0 is a sole proprietorship. You have one. You have always had one. The moment you sold anything for money, you were a sole prop by default. No filing required, no fee, no legal separation between you and the business. If the business gets sued, you get sued. Your savings account, your car, your apartment security deposit, all of it is reachable. There is no wall. Level 1 is the single member LLC. You file articles of organization with your state. Typical cost ranges from $50 in Kentucky to $500 in Massachusetts, with most states landing between $50 and $150. You get a certificate. You open a separate business bank account. You do not touch that account for personal expenses. That last sentence is not a suggestion. It is a load-bearing wall of everything you just built. Here's where people wreck it before the ink dries. They use the business debit card for groceries. They pay their Netflix from the business checking. They reimburse themselves informally and do not document it. They Venmo money between accounts without any paper trail and call it a transfer. This is called commingling, and it is the mechanism by which a court decides your LLC never actually existed as a separate entity and holds you personally liable for everything anyway. The legal term is piercing the corporate veil. The practical term is losing the only thing the LLC was designed to give you. Fake expenses are the next failure mode. A new laptop for a business that has no computer-facing operations. A business dinner with your spouse at a restaurant you go to every Friday regardless. A home office deduction on a floor plan that cannot physically support it. The IRS has seen every version of this. The audit rate for self-employed individuals with Schedule C losses runs higher than most people expect, and the documentation standard is not what you assumed. You need receipts. You need a log. You need the connection between the expense and the revenue generating activity to be something you could explain to a stranger in 45 seconds without hesitating. Missing filings are quieter but compounding. Annual reports, franchise taxes, state level LLC fees that recur whether you made money or not. If you formed an LLC in California, you owe $800 per year to the Franchise Tax Board, starting the year you form it. Not the year you earn money, the year you exist. Miss that and penalties accumulate on a business that might have made $1,400 total. The entity is now a liability. Sales tax is its own category of pain. If you sell physical goods, digital products in certain states, or taxable services, you may have nexus in multiple states and no idea what that means until a state revenue department sends a notice. Payroll taxes are another trap entirely. If you hire anyone, including yourself as an S-Corp owner, the rules around reasonable compensation, self-employment tax, and payroll filings are technical enough that most first-timers get them wrong the first year and pay a CPA to fix it in year 2. Now, the anonymity question, because this is where the mythology becomes dangerous. People form LLCs because they have heard you can hide behind them. Here's the current reality. The Corporate Transparency Act, which took effect in the United States in 2024, requires most LLCs and corporations to report beneficial ownership information to FinCEN, the Financial Crimes Enforcement Network. That means the name, date of birth, address, and identifying document of every person who owns 25% or more or exercises substantial control. Banks already require this for business accounts through Know Your Customer rules. Courts can subpoena operating agreements and ownership records. The IRS can see through nominee arrangements. A state attorney general with a subpoena can reach almost anything. The people who thought an LLC in Wyoming or New Mexico made them invisible were operating on information that was outdated before it was ever accurate. Anonymity and privacy are not the same thing. Privacy is a byproduct of clean, compliant structure. Anonymity is usually an illusion with a paper trail 3 steps deep, which brings us to the behaviors that turn a legitimate privacy structure into a criminal exposure. Using a nominee to be the listed owner while you retain actual control and fail to report yourself as a beneficial owner. Using a fake address with no real connection to any business activity. Fabricating invoices from one entity to another to move money without economic substance behind the transaction. Using an entity to make representations to a bank or a counterparty that you know are false. These are not gray areas. They are the behaviors that convert a $50 filing into a federal file. The structure did not commit fraud. The behavior did. And the structure, the very thing you built to protect yourself, becomes the evidence. So here is the ladder logic for everything that follows. Every level above this one buys something specific. A multi-member LLC buys governance structure and partnership-style tax treatment. A Series LLC buys internal liability separation between assets without separate filings. An S-Corp election buys self-employment tax efficiency at the cost of payroll requirements. A C-Corp buys institutional financing readiness and retained earnings treatment. Each level up adds advisor complexity, annual compliance cost, audit trail density, and consequence severity if you misuse it. The protection is real. The compliance obligation that makes the protection real is also real. You do not get one without the other. That is the trade at every rung of this ladder, and the people who skip that sentence are the ones who show up in the third paragraph of those indictments. Level 2 is where the structure starts to earn its complexity. You have an operating business. It generates revenue. It has contracts, employees or contractors, accounts receivable, maybe a lease. It also has exposure. Every contract is a potential dispute. Every employee is a potential claim. Every piece of equipment, every account balance, every asset the business has accumulated sits inside the same entity that absorbs every liability the business generates. Level 1 solved the personal separation problem. Level 2 solves the internal concentration problem. The holdco and opco structure is not exotic. It is standard enough that most commercial lenders expect to see it and most sophisticated partners prefer it. The operating company, the opco, runs the business. It holds the contracts. It employs the people. It takes the revenue and the risk. The holding company, the holdco, owns the opco and holds the assets worth protecting. Real estate, intellectual property, equipment of significant value. The logic is that if the opco gets sued and loses, the holdco and its assets are not automatically in the judgment. The plaintiff has a claim against the opco. They do not have a direct claim against what the holdco owns, provided the separation is real and documented. Lenders like this structure because it clarifies collateral. Partners like it because it clarifies what each party actually owns. It forces you to answer questions about your business that you should have been answering anyway. Who owns what? What flows where? What is the actual asset base versus the operating cash flow? The paperwork discipline is not administrative punishment. It is evidence of a real structure. Intercompany agreements, management fee arrangements, lease agreements between the holdco and the opco if the holdco owns the property the opco operates from. These documents have to exist, be signed, be dated, and reflect economic terms that a stranger would recognize as real. A management fee of $40,000 a month from a company generating $60,000 in revenue is not a real term. A court will say so. Level 3 is multi-entity liability segmentation. You have more than one line of business, multiple brands, a product division, and a services division, 3 rental properties with different risk profiles. The reason to split is concrete. A lawsuit against brand A should not reach the assets of brand B. A contract dispute in the services division should not threaten the product inventory. Separate entities mean separate exposure, separate accounting, and separate cap tables if investors are ever involved. The trade-off is overhead. each entity needs its own bank account, its own annual filings, its own registered agent fees, which run $50 to $300 per entity per year depending on the state, its own bookkeeping, a 3-entity structure that was costing you $800 a year in compliance at level 100 a year in compliance at level 1 now costs $3,000 to $6,000 annually before you have paid anyone to do the actual accounting work. You are paying for real separation, and the separation is only real if you maintain it. One entity paying another entity's expenses, informally, without documentation, collapses the boundary you paid to build. Level 4 is a special purpose vehicle, a specific project, a specific asset, a real estate acquisition, a film, a venture investment, a joint venture with a single partner for a defined purpose. The SPV is formed to hold exactly that thing and nothing else. When the project is done or the asset is sold, the SPV winds down. The appeal is clear. Losses in the SPV do not reach your other entities. Investors in the SPV own that project, not your entire operation. The liability is theoretically contained. The practice is more complicated. Personal guarantees on the SPV's financing attach you directly, regardless of the entity structure. If you guaranteed the loan, the SPV's walls do not protect you from the lender. Cash flow arrangements, where the SPV's revenue is routinely swept into your operating account without a documented basis for the transfer, undermine the separation. The magic shield of the SPV survives only when the economic substance of its separateness is maintained in every transaction, every month, without exception. Banking is where theory meets friction. Every business account opening involves know your customer review and, for entities above a certain complexity, source of funds questions. The bank wants to understand where the money came from, who ultimately controls the entity, and whether the transaction activity matches the stated business purpose. An LLC formed 3 weeks ago that immediately receives a $180,000 wire from an unrelated foreign entity will generate a suspicious activity report before you have ordered business cards. Banks close accounts. They do it without much warning and without detailed explanation. A multi-entity structure with frequent intercompany transfers that lack documented agreements will eventually trigger a compliance review at almost any institution. The documentation is not bureaucratic. It is the thing that keeps the account open. Transfer pricing matters even at the small business level. If your holdco charges your opco a management fee or your operating entity licenses IP from a related entity, the terms need to reflect what unrelated parties would agree to. The IRS standard is the arm's length principle. Transactions between related entities that shift income in ways that reduce tax without economic substance are the definition of the problem. This applies to domestic structures. It applies much more intensively to any structure with foreign elements. The reporting obligations scale with complexity in a way most people do not anticipate when they form entity number 2. Annual filings per state per entity. Payroll filings if any entity has employees. 1,099s for contractors above the threshold per entity. Sales tax nexus analysis if any entity sells into states where it has economic presence. State-level franchise taxes that apply whether the entity earned money or not. Controlled entity reporting requirements that apply once you own enough entities that the IRS wants a consolidated picture of what you control. Failure modes carry real consequences. Veil piercing happens when the separation between entities was documented but not practiced. Fraudulent conveyance is the legal doctrine that says you cannot transfer assets out of an entity to protect them from a creditor you already know is coming. The transaction can be unwound by a court. Insolvency mistakes, continuing to operate and incur obligations when an entity cannot pay its debts, can in some circumstances attach personal liability even to properly structured entities. Documentation gaps are quieter. The intercompany agreement that was never signed, the meeting minutes that were never kept, the resolution authorizing a major transaction that did not exist. These are the things that collapse the structure when a litigator asks to see the records. The cost and control ladder runs roughly as follows. A 2-entity holdco and opco structure, maintained with basic bookkeeping and annual filings, runs $2,000 to $5,000 per year with a competent accountant. Add a third entity or an SPV and you are at $4,000 to $9,000. Add an attorney for governance documents, operating agreements, and intercompany contracts, and the range moves to $8,000 to $20,000. Add an audit, which institutional investors or certain lenders will require, and you are above $15,000 annually before the audit itself. What you are paying for at each stage is not the entity. The entity is the $150 filing. What you're paying for is governance, defensibility, and records that survive scrutiny. Those three things are what make the structure real in a courtroom or a lender's due diligence process. The entity without them is a certificate in a drawer. The structure with them is the thing the ladder was built to reach. Level 5 is where the structure stops looking like a business and starts looking like an architecture. A private holding network is not one holdco above one opco. It is a deliberate arrangement of entities, sometimes across multiple jurisdictions, designed to separate governance from control, from risk, from cash flow. A parent entity owns stakes in several intermediate holdcos. Each intermediate holdco owns operating entities or assets or other holdcos. Different members of a family or different classes of investors sit at different levels. Voting rights, economic rights, and decision-making authority are not the same thing at every layer, and that divergence is intentional. The complexity is a feature. A liability at one operating entity does not automatically travel upward through the chain to threaten the rest of the network. A governance dispute between two partners in one subsidiary does not give them a window into the books of an unrelated subsidiary in the same network. A regulatory problem in one jurisdiction does not immediately contaminate entities domiciled elsewhere. Each of those separations has to be legally constructed, economically substantiated, and actively maintained. The complexity is also a liability. More entities mean more filing deadlines, more registered agents, more bank accounts, more compliance reviews, more intercompany transactions that need documentation, and more surfaces for error. A network that was assembled for defensible reasons can become indefensible if the administration deteriorates. Level 6 introduces trusts and foundations. These are not entity types in the ordinary sense. They are legal relationships. A trust has a settlor who creates it, a trustee who administers it, and beneficiaries who receive from it. When a trust owns an entity in the network, the governance of that entity is now governed by the trust document, which can run decades forward, specify conditions on distributions, and impose guardrails that survive the death of the person who created the structure. That is a succession function. The founder is gone. The assets continue to be administered according to instructions written while the founder was alive. For family enterprises, this is not privacy theater. It is how multi-generational wealth avoids being liquidated by a probate court or divided into irrelevance by competing heirs. The word privacy needs to be addressed directly. Privacy in a trust structure means that the beneficial ownership information is not published in a public registry. It does not mean the information does not exist. Trustees maintain records. Courts can compel them. Regulatory authorities can subpoena them. Divorce proceedings, estate disputes, creditor actions, and government investigations all have legal mechanisms to reach information that was never intended for the general public. What varies is jurisdiction. Some jurisdictions require public disclosure of beneficial ownership. Others maintain private registries accessible to regulators and law enforcement. Others have weak registries and are used specifically because of that weakness. Banks, regulators, and journalists understand this geography. The choice of jurisdiction communicates something about intent, and that communication is read. Level 7 is the family office, independent directors who are not family members, annual audits by external firms, written investment policy statements, valuation procedures that apply the same methodology every year to every asset, documented and defensible, formal compliance programs, employee handbooks, insurance policies covering directors, officers, and the entity itself, reporting packages reviewed by people whose job it is to find problems before the problems find someone else. This level costs between $1 million and $4 million annually to operate properly. It is not the compliance overhead that amateurs imagine. It is the permanent paper trail that makes the entire network legible to any serious inquiry. Here is the discomfort. These systems do exactly what they are described as doing. They protect assets, preserve family control across generations, and reduce exposure to legitimate risks that wealthy families face, including litigation, public scrutiny that creates safety concerns, and the instability that comes from concentrated illiquid wealth. They also create conditions that enable abuse when operated without integrity. Wealth hidden from a spouse in divorce. Assets move beyond the reach of creditors in anticipation of a judgment. Beneficial ownership concealed from tax authorities in the home jurisdiction. Funds from criminal enterprises moved through layers of legitimate-looking entities. Sanctions evaded through structures designed to obscure the connection between the sanctioned person and the asset. Regulators, banks, and investigative journalists look for patterns. Entities with no apparent business purpose. Transactions without economic substance. Ownership chains that terminate in jurisdictions known for weak disclosure. High-value assets registered to structures with no identifiable beneficial owner. These patterns trigger reviews. Banks file suspicious activity reports. Regulators open examinations. Journalists request documents and cross-reference them. High-profile cases have unraveled through exactly this process, not because the structure was discovered, but because the pattern was recognized. By a compliance officer doing a routine review, by a reporter who obtained a database leak, by a counterparty's bank that asked one question the structure was not prepared to answer. Misuse is not a gray area at the end of this road. Money laundering, tax fraud, sanctions evasion, and false filings carry criminal exposure. The structure does not protect the people inside it from that exposure. It concentrates the evidence of it. The takeaway ladder is simple. Match the structure to the actual risk. A Delaware LLC costs $150 and handles most legitimate needs at level 1. Every layer you add should solve a documented problem, carry a documented rationale, and come with a qualified attorney and accountant who understand the reporting obligations that attach to it. Document everything. Disclose what you are required to disclose. Stay inside the lines on beneficial ownership reporting, which is expanding globally and not contracting. The structure that survives scrutiny is the one built for scrutiny. That is the only version worth building.